On Friday, all big banks including JPMorgan, Wells Fargo, Citigroup, and Bank of America reported their quarterly results. And in their report, all of these banks sent a clear message to their investors that they are preparing for a recession. A slew of economists think that the US is heading for a recession in 2023. But how severe the recession will be, that is up for debate. Many argue that the recession should be shorter and milder than the last two recessions. But a small downturn can lead to an equally disappointing recovery. The chief of global strategies for JPMorgan Asset Management is calling the upcoming recession a swamp recession, indicating the economy would likely struggle to get out of it. The upcoming recession may not see job losses like the Great Recession or pandemic recession, because there is a chronic lack of labor supply in the market. So the recession may not spike the unemployment severely, but it would linger. There is a white-collar recession going on right now, while the blue-collar is booming. No matter how long or severe the recession will be, the major financial institutions are in convergence on the 2023 economic outlook. The big banks reported strong results in the fourth quarter. Chase reported net income of $4.5 billion, up 9.5% from last year. Bank of America posted a profit of $3.5 billion, up 14.5% from a year earlier. Shares of JPMorgan, Bank of America, and Citigroup all closed up over 2%. The consumers are borrowing more to sustain their living standard at a higher rate. As a result, banks are enjoying profit from consumer spending, but they expect the momentum could soon recede. So the banks are preparing for the gloomy economy for the upcoming future. JPMorgan set aside $1.8 billion in provision for credit losses, the money they won't be paid back by the borrowers. Bank of America, for its part, set aside $1.1 billion for credit losses in the fourth quarter, Wells Fargo $936 million, and Citigroup another $640 million. As a group, these banks set aside more than $4 billion in loan loss provisions. JPMorgan expects that the US unemployment rate could reach 4.9% in the upcoming recession. Although the economy is currently strong, the effect of upcoming headwinds from the geopolitical tension, the state of energy and food supplies, persistent inflation, and unprecedented quantitative tightening still remains unknown. Bank of America calls for a 5.5% unemployment rate at the start of 2023, and will remain above 5% through the end of 2024. The bank is seeing outstanding balances on credit cards are up 14% from last year, saying the delinquencies are rising after they remain unusually low during the pandemic. Citigroup analysts expect unemployment rate to reach up to 5.25% this year. According to their report, more than 2 million people will lose their jobs, including 400,000 construction jobs. Business impacted by the housing market are already sounding alarms. They also expect a collapse of housing market at a level not seen since 2008. According to the large banking institutions, the recession is all but inevitable. The Federal Reserve has failed to control the inflation, let alone an entire economic downturn. Although there are differences in opinion among the financial institutions about the timing and the severity of the recession, none of them are denying the inevitability of it. However, these institutions do see a rebound of economic growth by the mid-year, or the end of the year. Until then, they are all preparing for the recession that is coming our way.